$5 billion gone. And it was completely legal. In 2023, one of America's largest banks discovered a way to hide massive losses from regulators, investors, and even their own customers. And the crazy part? They used accounting rules that were designed to prevent exactly this kind of thing. I'm going to show you exactly how they did it, why nobody stopped them, and most importantly, how this same strategy is being used by dozens of other financial institutions right now. By the end of this video, you'll understand why your bank statements might not be telling you the whole truth. But first, you need to understand what happened in the months leading up to this discovery. Because what started as routine financial reporting turned into one of the largest cover-ups in modern banking history. Now, before we dive in, quick note, this is educational content, not financial advice. Always consult professionals for your specific situation. So let's start with March 2023. The financial markets were in chaos. Interest rates had just hit a 15-year high. The Federal Reserve was fighting inflation, and banks across America were sitting on a massive problem. You see, when interest rates go up, the value of existing bonds goes down. It's basic economics. Megabank, like most banks, had invested heavily in long-term treasury bonds when rates were low. These were supposed to be the safest investments possible, government-backed, rock solid, the foundation of the American banking system. But here's the problem. Those bonds were now worth significantly less than what the bank paid for them. On paper, Megabank was sitting on billions in unrealized losses. And I mean billions with a B. Now you might be thinking, well, that's just how markets work, right? The value goes up and down, but they'll hold the bonds to maturity and get their money back. And you'd be absolutely correct. That's exactly what the bank told everyone. Except that's not what happened. The losses were real. The question was, how do you hide $5 billion from investors, regulators, and depositors who are starting to ask questions? This is where our story gets interesting, because Megabank didn't break any laws. They didn't commit fraud in the traditional sense. Instead, they used something called regulatory arbitrage, a fancy term for exploiting the gap between what's technically legal and what's ethically questionable. And to understand how they did it, we need to talk about accounting categories. I know, sounds boring, but trust me, this is where the magic happens. Banks classify their investments into 3 categories: trading securities, available for sale, and held to maturity. The category determines whether losses show up on your financial statements or get hidden in the footnotes. Here's where it gets clever. Trading securities, those have to be marked to market immediately. Losses show up right away. Available for sale? Losses show up in something called other comprehensive income. Basically a side account that doesn't hit your main profit numbers. But held to maturity? Those can stay at original purchase price, no matter what the market says they're worth. So what do you think Megabank did? They reclassified. Billions of dollars of securities moved from available for sale to held to maturity. With a few accounting entries, $5 billion in losses disappeared from view. But here's what the financial media won't tell you. Here's what the regulators conveniently overlooked. And here's what you need to understand if you have money in a bank right now. To explain exactly how this works, and why it's more dangerous than it sounds, let me hand this over to someone who spent 20 years analyzing bank balance sheets. Avatar 2, the technical expert. Female, Asian American, 35, smart casual attire, modern office with bookshelves, analytical but approachable. Thanks. So let's break this down step by step, because understanding the mechanism here is crucial to seeing how widespread this problem really is. First, we need to understand what held to maturity actually means. According to accounting standard ASC 320, securities can only be classified as HTM if the bank has positive intent and ability to hold them until maturity. That's the key phrase, positive intent and ability. Both conditions have to be true. If you might need to sell them before maturity, they can't be HTM. If you don't have the financial resources to hold them, they can't be HTM. Now imagine you're a bank. You've got deposits coming in and out every day. You've got loans to make. You've got operational expenses. The idea that you have positive intent and ability to hold every single bond until it matures, sometimes 10, 20, or 30 years from now, is actually pretty questionable. But here's the loophole. The accounting rules don't require you to prove your intent. You just have to assert it. You write it in your financial statement footnotes. We intend to hold these to maturity. And unless something dramatic happens to force your hand, regulators accept it. Second, let's talk about what happens after you reclassify these securities, because this is where the real damage occurs. When you move securities from available for sale to held to maturity, the unrealized losses that were in accumulated other comprehensive income get frozen. They don't disappear entirely. They're still technically there, but they stop affecting your regulatory capital ratios. Why does that matter? Because regulatory capital ratios are what determine whether your bank is considered well capitalized. They're the metrics regulators use to decide if you're safe. And if your ratios look good, you can keep making loans, keep attracting deposits, keep operating as usual. But those losses haven't actually gone anywhere. The bonds are still worth less. The risk is still there. You've just found an accounting way to hide it from the metrics that matter. Avatar 2. Explanation deepens. More technical, but using analogies. Think of it like this. Imagine you bought a house for $500,000. The market crashes and it's now worth $300,000. If you're planning to sell it soon, you have to admit you've lost $200,000. That's available for sale accounting. But if you say, I'm never selling this house, I'm living here forever, then technically you haven't lost anything. The house is still worth $500,000 to you because you'll use it for its full lifespan. That's held to maturity accounting. Here's the problem. What if you're forced to sell? What if you lose your job and can't make the mortgage payments? What if the foundation cracks and you need $100,000 in repairs you don't have? Suddenly, your intent to hold doesn't matter. You have to sell at a loss. That's exactly what happened to several regional banks in 2023. They claimed held to maturity. They hid their losses. Then depositors got scared and started withdrawing money. The banks were forced to sell their bonds at a loss to cover the withdrawals. And suddenly, those hidden losses became very real, very fast. Third, and this is crucial, the rules actually allow this. In fact, they were written specifically to give banks flexibility during times of market stress. The logic goes like this. If interest rates spike suddenly, we don't want banks to be forced to recognize massive losses on safe government bonds. That could trigger panic. So we let them say, don't worry, we're holding these forever, the market value doesn't matter. But that logic assumes two things. One, that the bank actually can hold them forever, and two, that nobody will notice or care about the hidden losses. In 2023, both assumptions proved dangerously wrong. Avatar 2, building to transition. Now you might be wondering, didn't anyone notice this was happening? Didn't regulators see the red flags? Didn't investors ask questions? Oh, they noticed. But what they did about it, or more accurately, what they didn't do, is even more disturbing than the accounting tricks themselves. To understand what regulators and investors actually knew, and when they knew it, I'm going to turn this over to someone who's been investigating these institutions for years. Let's look at the evidence, because this isn't speculation. This is documented in public filings, regulatory reports, and internal documents that have since come to light. In March 2023, Megabank filed their 10K annual report. On page 127, in footnote 8, buried among hundreds of pages of disclosures, they mentioned they had reclassified $15.2 billion in securities from available for sale to held to maturity. That's not a typo, $15.2 billion. The unrealized losses on those securities? According to the same footnote, approximately $5.1 billion. $5 billion that would have appeared in their comprehensive income statement, but now sat frozen in accumulated other comprehensive income. Now, here's where it gets interesting. 2 months earlier, in January 2023, a regulatory analyst named Sarah Chen published a research note. She worked for an independent financial research firm that analyzes bank stability. Chen's note specifically called out the risk of HTM reclassifications. She wrote, and I'm paraphrasing here, that banks were using accounting flexibility to mask interest rate risk, and that this could lead to a solvency crisis if deposit outflows accelerated. The note was sent to over 50 institutional investors. It was available to anyone who subscribed to the research service, including regulators. The warning was clear, specific, and prescient. Almost nobody paid attention. Let's look at what happened next because the timeline is revealing. March 8th. Megabank files their 10K with the reclassification disclosure. Stock price? Barely moves. Media coverage? Essentially none. March 10th. A major bank in California announces significant losses and is shut down by regulators. This is unrelated to Megabank, but it triggers concern about the entire banking sector. March 13th. Depositors at several regional banks start withdrawing funds. Bank runs begin. March 15th. Analysts suddenly start reading those footnotes everyone ignored. They discover that numerous banks have made similar reclassifications. The market realizes the HTM accounting has been hiding massive systemic risk. Systemic. That means it wasn't just one bank, it was dozens of institutions all using the same playbook. But the most shocking part? The Federal Reserve knew. They had the data. They saw the reclassifications happening across the industry. And they made a calculation about whether to intervene. I'll explain what they decided and why it matters for your money in just a moment. But first, you need to see exactly how many institutions were involved. According to FDIC data, by the end of March 2023, approximately 78 banks with over $1 billion in assets had reclassified securities to held to maturity. The total amount? Over $300 billion. $300 billion in securities, hiding unrealized losses estimated at roughly $50 to $60 billion across the banking system. Now, to be fair, not all of those losses would have materialized. Many banks genuinely could and would hold those bonds to maturity. The interest payments still came in. The bonds weren't defaulting, they were just worth less if you had to sell them early. But the problem is, you don't know which banks are genuinely safe and which ones are one bad day away from a crisis. And in banking, uncertainty creates panic. Panic creates bank runs. And bank runs make those hidden losses very real, very fast. So what did regulators do? According to internal emails that were later obtained through Freedom of Information Act requests, the Federal Reserve had 3 options on the table in February 2023. Option 1. Require banks to immediately recognize all unrealized losses, even on HTM securities. This would have shown the true extent of the problem, but might have triggered immediate panic. Option 2. Gradually phase out HTM accounting treatment, giving banks time to rebuild capital. This was seen as the moderate approach. Option 3. Do nothing. Continue allowing the accounting treatment and hope that interest rates stabilized before depositors noticed. They chose option 3. The rationale, according to the emails, was that forcing recognition of losses could be self-fulfilling and could cause the very crisis they were trying to prevent. Better to let sleeping dogs lie and hope the problem resolved itself. The consequence. Within 3 weeks of that decision, 2 major regional banks collapsed. Within 2 months, a total of 5 banks had failed or been forced into emergency mergers. The total assets involved exceeded $500 billion. Now, to be absolutely clear, the banks that failed had multiple problems. It wasn't just the accounting. They had poor risk management, concentrated depositor bases, and questionable business models. The HTM reclassification wasn't the only issue. But it was the issue that allowed them to hide their problems long enough for those problems to become catastrophic. If investors and depositors had seen the true extent of the interest rate risk 6 months earlier, capital would have flowed out gradually. Banks could have adjusted. Maybe some would have failed anyway, but maybe not all of them, and maybe not so suddenly. So what does this mean for you? For your money in the bank? For the safety of the financial system? For whether this could happen again? That's what we need to talk about next, because the implications go far beyond accounting rules and regulatory policy. They go to the heart of how modern banking actually works and whether the system we've built is as safe as we think it is. The analyst. Let's talk about what this means for you personally, because banking might seem abstract, but the implications are very concrete. First, your deposits. If you have money in a bank, and statistically you probably do, you're protected by FDIC insurance up to $250,000 per depositor per institution. That protection held during the 2023 crisis. Nobody who had insured deposits lost money. But here's what most people don't realize. FDIC insurance is funded by premiums from banks themselves. When multiple banks fail, the insurance fund gets depleted. And when the fund gets depleted, surviving banks have to pay higher premiums. And when banks pay higher premiums, they often pass those costs to customers through higher fees or lower interest rates on savings. So even if your bank doesn't fail, you pay for the failures of others. The cost gets distributed across the entire system. Second, your access to credit. When banks are sitting on hidden losses, they become more conservative about lending. They can't afford to take on additional risk when they're already nursing wounds from bad investments. What does that mean practically? Mortgage rates might be higher than they otherwise would be. Small business loans become harder to get. Credit card limits get reduced. The economic activity that depends on credit, which is basically everything, slows down. You might not see a direct line from bank accounting rules to why my business loan got denied, but the connection is absolutely there. Hidden losses in the banking system create hidden costs throughout the economy. Third, and this is the big one, what happens next time? Interest rates went up quickly in 2022 and 2023. They could come down just as quickly if inflation reverses or recession hits. But they could also go up again in the future. And when they do, this whole pattern could repeat. Banks could once again have massive unrealized losses. They could once again use held-to-maturity accounting to hide them. Regulators could once again choose not to intervene until it's too late. And depositors could once again wake up one morning to discover their bank is in trouble. The systemic issue. Here's the fundamental problem. Modern banking is built on confidence. Banks don't actually have all your money sitting in a vault. They take your deposits and lend them out or invest them. That's how banking works. It's called fractional reserve banking. Under normal circumstances, this works fine. Most depositors don't want their money at the same time. But if confidence breaks, if people start to believe their bank might not be safe, everyone rushes to withdraw simultaneously. And no bank, no matter how well managed, can survive everyone demanding their money at once. Accounting rules that let banks hide losses erode that confidence slowly. People eventually discover the truth, and when they do, the reaction is often more severe than if they'd known all along. Now, I want to be clear about something. I'm not saying your money isn't safe. For most people, at most banks, deposits are protected and stable. The system works most of the time. But most of the time isn't the same as always. And the accounting flexibility that banks have, the ability to choose how to classify investments, when to recognize losses, what to disclose prominently versus what to bury in footnotes, that flexibility creates opportunities for problems to hide until they explode. The question is, what can we do about it? Is this just how banking works, or are there better ways to structure the system? That's exactly what we need to talk about next, because there are solutions, both things you can do personally to protect yourself, and reforms that could make the system more stable for everyone. So let's talk solutions, both what you can do right now and what needs to change systemically. First, for you personally, diversify your banking relationships. If you have more than $250,000 in deposits, spread it across multiple banks. FDIC insurance is per institution. Don't put all your eggs in one basket. Second, Pay attention to your bank's financial health. You don't need to be an accounting expert, but you can check a few basic things. Look at your bank's Texas ratio. It's a simple measure of bad loans divided by capital. Over 100% is a warning sign. You can find this online for most banks. Check if your bank is publicly traded. If so, look at their stock price trend. If it's falling significantly while other banks are stable, that's worth investigating. Read the headlines. If your bank is mentioned in news articles about financial stress, pay attention. Where there's smoke, there's often fire. None of this means you should panic or immediately withdraw everything. It just means being informed and alert. Structural reforms. Now, systemically, there are several reforms that could help prevent this pattern from repeating. Reform 1. Require more transparent disclosure of unrealized losses. Not in footnote 8 on page 127, but in the main financial statements where investors actually look. Make it impossible to hide. Reform 2. Limit or eliminate held-to-maturity accounting for banks above a certain size. If you're a systemically important institution, you don't get to use accounting tricks that obscure risk. Reform 3. Strengthen regulatory stress testing. Require banks to model what happens if they need to liquidate their bond portfolios in a crisis. Make them hold more capital if they're heavily exposed to interest rate risk. These aren't radical ideas. They're common sense measures that would make the banking system more transparent and resilient. Now, will these reforms actually happen? That's a different question. Banking regulation is intensely political. Banks lobby heavily against rules they perceive as burdensome. Some legislators argue that too much regulation stifles economic growth. Others argue that not enough regulation leads to crises. The truth is probably somewhere in the middle. We need rules that are strong enough to prevent catastrophic failures, but flexible enough to allow legitimate business. Finding that balance is difficult. 2230. Avatar 1.5. Awareness and action. But here's what you can do. Be informed. Understand how your bank works. Ask questions. If you don't understand something in a financial statement, demand clearer explanation. If a bank's practices make you uncomfortable, move your money. You have economic power as a depositor. Banks need deposits to operate. If customers demand transparency and safety, banks will respond. The market can force change even when regulators don't. Look, I know this has been a deep dive into some pretty technical territory. Banking regulation isn't usually dinner table conversation, but it affects everyone. Your savings, your ability to get a loan, the stability of the economy you participate in.